concept first. If we were going to start someplace, the first place to start when it comes to building credit is with what's called an authorized user, right? Now, why am I starting here? Well, because again, we inherit or we learn how to manage our finances from our parents and from those that are closest around us, right? Our parents, you know, our parents kind of give us the message and the mantra of, you know, go to school, get a good job, work hard. But none of these three concepts that we hear so often teaches us about how to manage the money that we're getting from the good job, from the good education that we went out and got. None of that does that, right? Authorized user account, well, this is another way of inheriting better credit. Why? Firstly, authorized user account, you only want to use this with someone you know has someone that
You want
has
to
good
answer?
credit, someone who's got good credit. All right. So you definitely don't want to go out and jump into the credit bed, so to speak, with someone who does not have good credit, especially on an authorized user account, because the whole point of the authorized user account is to inherit the good history of payments, the good payment history. So if you get an authorized user account with someone who's got poor credit history or poor credit payment history, what did you just inherit? The same
Yeah.
thing. All right. So this is a safe way to, you know, provide our children early enough in life with a way to start building their credit in a way that we can manage as the custodians and caretakers of our children, right? This is a way for us to do that. Start them off young, you know, so that way when they are old, they will not
Depart.
part. Okay. I like this comment in the chat real quick that I got sent to me on a direct message. My credit line scores increased 30 points because of how I made Apple refund credit to Capital One.
Mhm.
That got designated as an adjustment. The credit line increased 2,500. I'm guessing it was lower than that before. Very big difference. Good move because all I had to do was know consumer rights, I guess. It took a phone call, man. Exactly. And that's also part of it, right? Knowing game. All right. So I'm just going to put that down as number two. Why? Because you're going to learn the game from someone that is showing you the game, right? You're going to learn, you're going to know what to do, how to move based on who you're learning from or who you decided to partner and collaborate with on improving your own credit score. So if you got a parent who's got a really good credit score, right? Or a history of payments and
Mhm.
all that stuff, you can totally ask for an authorized user account that way. Got a grandparent who is no longer actively using their credit cards, but they've got an excellent history of credit repayment and everything else like that. Grandparents are great people to partner with for grandchildren
Mhm.
on authorized user accounts. Here's also what happens with also knowing this game. Once you've got the authorized user account, do you use that credit? Simple
Yeah.
answer.
Yeah, you should use it, but I believe only a certain percentage of it you should use per month.
Absolutely. So 30% credit utilization.
Make sure it stay in the 30s.
Mm-hmm.
You know what I mean? And stay well underneath the 30. If you
Yep.
can stay under 25, you're doing yourself a huge favor.
Mm-hmm.
Okay. Now remember, if you guys have comments, put the comments into the chat. All right. So that way I can, if you have, or if you have some insight and you want to share that, this is an open discussion. We're starting with personal credit. We are going to move into business credit, but you've got to know how to manage your personal credit first before you get into business credit. Because let me just put this down here right now. Business credit is going to require a personal grantor to get started.
Crazy.
All right. A personal grantor is what you need in order to get started building your business credit. Why do I say that? Well, because you're going to go to a creditor. And if you don't have any credit history for your business, because this is a brand new entity, what does your business have? Your business has an EIN. What is an EIN? It's a personal identification number specifically by the IRS to track who's making what kind of financial contributions, withdrawals, etc., into the economy. All right. Now, on your personal credit, what happens? You got your social security number. And like we talked about last week when we were talking about trust and what a trust does, it helps protect the creator and the grantor from public liability or public record information or disclosing that information. When a person creates a business, they're creating for themselves protection from legal liabilities, lawsuits, being sued, all right, being attacked commercially. All right. So if you want to get out of making your social security number a victim of these two things,
Mhm.
ID theft and fraud.
Mhm.
And here are some things that you also want to know about your personal credit, right? Because again, you don't go over the 30% credit utilization. Why? Let's use an example. You've got $1,000 issued to you by Capital One. They don't tell you anything about credit utilization. They offer you a 0% credit card for the first year, 12 months free. No interest rates. But this is a scam,
Mhm.
right? This is part of knowing the game. You got to know scams. And for those that don't know, scam means still confused.
About money.
That's right. So credit cards aren't a scam. You're just confused about money and no one ever told you how to use them, right? A lot of people never get told how to use the credit in a way that benefits them. So here's what we're talking about with the 30% credit utilization. You got $1,000, but 30% of 1,000 is how much?
300.
300. Easy math, right? You really only got $300 of real credit because once you go over the 30% threshold, your credit score will take a plummet. It's going to drop, right? So knowing that you don't want to go beyond the 30% credit utilization helps give you some boundaries of how much to spend. No one can tell you what to do with your money. No one can tell you not to go over the 30%. But if you do,
You get hit.
well, you get hit. And the credit reporting agencies, they're okay with reporting that information because it's part of your credit history, right? And your credit history is used to determine your credit worthiness by other potential creditors. So you've got your 30% credit utilization. We understand why not to go above 30%, right? But most people will use that 300 and they will say, well, I can use the $300 monthly, which is the worst way to think about it. When it comes to credit, we need to be thinking about long term, which means can you use this 30% credit utilization for 1 year's worth of services or goods or other products, right? Most people are going to say no. But if you can't do this with low amounts of credit, you will not be able to do this with large amounts of credit because you don't have the behavior and the discipline or the habits to keep yourself in check. So you want to think about annual services versus monthly. Okay. Why? I want you to use that 30% credit utilization to pay for a year's worth of services. If it's more than $300, you don't need it.
Right.
and I don't want to say that you don't need it. You may want it. It may help benefit you. It may help provide a comfort. It may, I don't know what it may do. But let's not screw the pooch here, okay? And let's not dance around the bush. Let's jump in this bush. Let's talk about it, all right? An annual versus a monthly. If you're thinking monthly, what happens with most service fees on a month-to-month basis? Are they more expensive or are they cheaper? Month-to-month service,
Month is more expensive.
more expensive. You're going to pay more money for that service, right? But now if we're thinking, okay, monthly, I get charged more, I pay more money out of my pocket. What if I pay annually? Well, if you pay annually, it's a lump sum, and now you got the minimum payment to make back to pay off the debt, right? So that's cool. And you can definitely do the minimum, but let's talk about minimum payments real quick, and then we can start getting into the business side of things, right? Yeah. So the minimum payments, and this is what I was kind of like alluding to on the 0%, right? After 1 year on that Capital One credit card that I mentioned, what's going to happen? After the first 12 months of interest-free minimum payments, your interest rate on that credit card is going to jump from 0 to 12, 16, or 20+%. Now, most people are thinking, oh, this is great. That's only because you don't understand interest payments or interest rates on credit, right? So let me put this here, the Bankers Rule, also known as Rule of 72. Let's explore this. The Rule of 72 basically states or approximates that based on the interest rate alone, anything that we divide into 72 will give us the approximate number of years it takes for us to double an investment or a debt. Okay? So now, if we divide 72 by 0, how long does it take to double an investment based on 0 as the interest rate? If you divide 72 by 0, what is 72? What does that get you?
That's 0. 0 divided by.
Exactly. I asked a very ironic question to ask you to bring you to the next question. As remember, 12 months, 0 interest, right? After 12 months, based on your credit worthiness, it jumps to 12%. If we divide 72 by 12, what's the number?
6. I don't want to give all the answers.
No, it's okay. So we got 6 years. At 12%, it takes 6 years for that debt to double based on the interest rate alone. And most people are only paying their interest rates, not the principal. So you got 12% on the interest that you got to pay. And most people don't understand how interest rates are calculated over an annual basis. So let me give you this juice real quick. Let me give you this sauce. All right. Annual interest divided by 365, right, gives you the daily interest rates. Add that up. 30 days on average month equals monthly interest rate, right? So every month people are paying an interest that's accumulating by the day, right? They make their minimum payment, but of that minimum payment, most of it goes towards the interest, Remaining difference, a very small amount, goes to the actual principal. This is dangerous because it means that if you are still only making minimum payments on your interest on a credit card, you will be, if you decide to engage in a 12% 6-year minimum repayment plan, you're going to double the money for the creditor. And that extra, all that extra interest rates that you could have saved yourself, that could have gone into your pocket to where you could have actually saved that money and used hard cash to purchase the things that you want or feel that you may need, you would not be in a position where you're in debt or trying to figure out the rest of this personal credit stuff, which makes you liable to default payments, right? Which add on additional charges. Well, if we keep doing this, it's no wonder our people are broke. Because the credit card companies are getting all the interest and we're not even tapping into we're not even touching the principal yet. All right, so I'm getting ready to jump into this business credit because now we've talked about all the dangers and the downsides from personal credit. What do we need to do? We need to have an authorized user account. What else do we need to do? We need to know the game and not be confused about money. We need to understand only using 30% of the total credit utilization. We need to understand an annual payment, an annual service that we're paying for with our credit versus a monthly service, because monthly services, higher service fees every month, more payments throughout the year. What are we doing? We're changing our behavior, we're changing our mindset, we're changing our mentalities, we're changing our concept and understanding about how credit works. So that way, when we create new forms of credit, new lines of credit, we're not repeating the same habits that put us into the debt in the first place, where, you know, we're trying to figure out, well, where's the extra money coming from? Well, I'm going to start a business. What are you going to do when you start a business? Well, I'm going to start a business. I'm going to charge for a service. Okay. And how long is it going to take you to get to a place where you have enough money to keep your business alive month to month to outlive you? How do you do that? Well, if your business isn't moving fast enough, if you're not making that money, this is the reason why people end up in debt. So let me check on the chat real quick, and then we'll get back onto this business stuff. Student loans are horrible. I got my promissory note yesterday. That's what I learned. Emotional spending. You know, there's this Instagram, there's this social media meme that goes around where the guy talks about people being emotionally damaged. All right, so that's the reason why I say it like that. Emotional spending, because you're emotional damaged. You know, you're trying to figure out your finances. No one teaches you. This is the reason why math isn't so important. All right. And if we think about how important math is, if again, our money managing habits we learn at home, not at school. We're not supposed to learn how to manage finances in school, because the school system is already designed to teach us how to be employees and work for other people and receive a paycheck, but not how to manage that paycheck. All right. So statements in the chat from my mother, and was warned against getting into a debt hole from my father. Mother said, warned against getting into debt. Father said, stay out the hole. that's all types of wrong there, but it's a good thing we're on a call with adults, right? What I saw was different than what I was told because I spent more time with my mother. So her relationship with money is what I witnessed. Good credit. That's, hey, here we go. Minimum payment keeps you on the hamster wheel. It certainly does. You fund the bank. It certainly does. This person in the chat they got some experience. I hope that experience is built on wisdom or the experiences of others that help them avoid getting into the same situations that the people that they learn from got into. Wisdom is learning from the experience of others, right? Being foolhardy is learning from yourself. So we can learn from ourselves or we can learn from the experience of others. I say let's do both. Let's do both, because some of the things that we learn from our parents, it's a new day and age, a lot, and you know, credit and social security numbers and how like identity theft this whole thing got started. Well, like let's think historically back into America's history. We're not going to go into other countries' history. We can only speak about our experience in this country. Let's talk history real quick, right? In 1933, Great Depression, right? People were asset rich but cash poor.
Mhm.
All right. I'll say that again. People were asset rich, but they were cash poor because people they had assets like art and statues and all these other things. But in economic crisis, art is an unstable investment. It depreciates in a recession, as a matter of fact. And if you don't believe me, look at the changing value on the Mona Lisa or the
Mhm.
Michelangelo or on David or on Picasso, any of Picasso's works, right? It, look at any of that and tell me what the value on those assets are consistently over time. They fluctuate every time there's a war crisis that happens. And the only people that really benefit are the art museums. They get to buy art that they stole from other countries.
Yeah.
I'm sorry. Whoa, whoa, whoa. That's not what you're on this call for. let me read it back in. Okay. So 1933, economic crisis happens. People are asset rich, but they're cash poor. What happens? Someone says, hey, I've got a great idea. Let's lend them more money. Oh, but how are we lending money? We're already doing loans. Only certain people qualify for loans. We only give the best rates to the people that we like the most, who have the most money, who understand how money works. That's why we give them we give them the better rates on their loans. We keep it as low as possible because their credit worthiness is worthy of a low interest rate. Ding, ding, ding. Your credit worthiness for a lower interest rate. All right. So somebody said, what we can do is we can actually make money on debt, because anytime someone borrows credit from us, oh, they've got to pay that back.
Yes.
Does anybody really want to like have to repay for money that depreciates in value every year by a thing called inflation,
Right.
right? Inflation, for those of you that don't know it, is purchasing power risk. Right? Every year you're suffering a 3% loss on every dollar that you have in your pocket. Okay. And part of the reason why people stopped putting their money in the banks is because when it was in the banks, well, the bank started loaning that person's money to other people, and they engaged in what was called fractional lending, which meant that they could loan it 9 times, which meant that your money had a value that was 9 times the actual value of what you thought it was. But no one told you this. And if someone would have told you, like, hey, become your own lender, or say like, don't become a lender, don't become a borrower at all, then a lot of us might have tried to avoid becoming a borrower in the first place, right? So business credit. Well, people could not afford personal credit anymore. Their personal scores got so jacked up, especially in 1933, which is when the Social Security number comes into play. Also with the Social Security. So Social Security numbers are for Social Security. Think about that. When you apply for a Social Security number, you use an SS5 form. When you apply for an EIN, you use an SS4 form. Okay. So in the IRS, the US Treasury Department, right? Well, they're the ones that have access to the Social Security forms. That's what SS means. SS5, Social Security 5, Social Security 4. All right. And if you work 10 cycles, right, excuse me, 40 cycles, which equals 10 years, 40 quarters, which equals 10 years, you qualify for Social Security. But most people who are able to access their social security numbers or actual social security, right? They do it at an age where they're receiving the absolute lowest amount of social security distribution to them. And so because social security did not help afford a lot of people the kind of financial stability that they needed, they end up turning to credit. And that's where personal credit got jacked up to the point where they needed to go and apply for a new 9-digit special number because no one taught them the game. They didn't understand how to use 30% credit utilization. They didn't understand annual interest payments, right? And so now, if you've ever experienced any of that, you know what not to do
Mhm.
with your business credit, right? You still keep the same concepts and principles that we had up here, right? Personal grantor, you're going to need it to get started. You know, and depending on your personal credit score, it's going to determine how much credit they offer you. All right. But regardless of how much credit they offer you, we already know. I'm just going to highlight these things and I'm going to do what? I'm going to paste them because that's it. That's the end of the game, guys and gals. That's the end of the presentation. Whatever you learned to do poorly with your personal credit, you've got to use that same knowledge to not repeat the same habits that you did with your business credit. All right. So if you use your business credit in a way where you're keeping your under the 30% utilization, right? Let's also talk about real quick secured credit, because this is also something that you can't do on a personal level. You certainly could try, but it's not going to benefit you the way that you want to. And here's why. Your social security number is still at risk. Done. Bomb. Drops the mic. Bag drop, as Dame Dash says, bag drop, right? So why would you use secured credit on your social security number when your social security number is now legally liable for all the public debts that the social security number has applied for? And because someone can easily access or get your social security number, it's easier than it's ever been. The dark web has certainly made sure of that.
Yeah.
Right? You can buy a person's social security number on the dark web. The same way that people buy what are these things called? CVNs, a CV number, right? And these things are nothing more than someone else's social security number and their credit worthiness that they're loaning out or lending someone else for a short period of time just to help them apply for higher limits of credit.
Can you repeat that again about what you just said about, you said secured credit?
So secured credit, right?
Mhm.
A secured credit is when you have enough money to put it into the bank. And thank you for putting that in there. Credit profile number, not a CVN number, a credit profile, CPN number. That's
Yeah. Okay.
CPNs, credit profile. Thank you. Right. So secured credit, you take your own money, you put it into an account, and you say, I want to borrow off this credit amount. You know, this is what my credit is going to be based on. Money that I put in. So you've already put up the collateral. So you get a much lower interest rate on a secured line of credit than you do on an unsecured line of credit because there's nothing guaranteeing
Right.
of the credit. When you have secured credit, though, you've already put up the collateral. If you wanted $2,000 of secured credit, you put up $2,000 of your own money. What does the bank charge you on the secured line of credit? Zero, right? Well, or close to zero. There's still an interest rate on it. You still got to repay the money because it's still credit. It's still debt. All right. It's just that now it's called a secured debt. And you've become the secured party creditor in your secured debt, which helps people understand equity even more, right? That's how the Chime credit card works.
Right.
see.
And in addition to that is a hack. If you do have a secure account, there's no pull, there's no credit pull on it.
Thank
And
you.
if you do it, say for instance, you have a $2,000 loan, you take out $1,900 and within 25 days before the cycle payment, pay it back.
Absolutely right.
And then it'll report to your credit card statement as a loan taken out, pay back in full in less than 30 days.
Mhm.
So it'll boost your credit score too.
It will, but now see what we just talked about now is using above the 30% credit utilization limit on the business side. The business can afford to take a momentary lapse as long as it comes right back up,
Mhm.
right? So if you use 1900 of a $2,000 credit limit, right? And as long as you're able to pay it off or repay it back within that cycle time,
Mhm.
you've just increased your credit score, but you want to do that for about 6 months and then go to the issuer of that secured line of credit and say, hey, payment history's been good. Why don't you either A, increase the line of credit, or B, decrease the interest rate, or C, expand the time that I have to repay the loan, or to repay the interest. All three of these ways are ways for you to hack your credit and make it better for you on the business side. Funny thing about this business credit though is that you don't have to have a business in order to enjoy business credit. And this is where we're going to come to an end, ladies and gentlemen,
All right.
because
I'm sorry, I'm gonna ask you to repeat those three things. So you said you can either ask them to increase the credit limit, decrease the
interest rate,
interest rate, or,
increase the amount of time.
oh, okay.
And trust me, infinite banking, you want to be careful about infinite banking because infinite banking, you still have to pay back the money. You still have, and if you don't pay it back, I know a lot of people are underneath the guise that, oh, I don't have to pay back the money in an infinite banking loan. You don't have to, because what they'll do is they'll take it out of what you actually set up for. So like if you're using infinite banking and insurance in an insurance vehicle, that now I get why the laughing face is there too, because this person already knows. We had this conversation, bro. You already know. You know, maybe the condos and doors going to do that. Maybe they will, right? But with the infinite banking, you still have to, like infinite banking insurance products, you still have to pay back the money. If you don't pay it back, they take it from the insurance, and now
Mhm.
you're in the hole. Like our other comment mentioned earlier, what their father told you not to do, stay out the hole. Someone got themselves in the hole, and it wasn't the good hole; it was the bad hole. Okay, maybe another adult joke right there. I'm sorry.
Mhm.
But so these are things that we want to avoid, right?
Mhm.
Hole in one. Yo, the chat is crazy right now. The chat is going wild. I love it. But so guys, you don't have to have an incorporated or registered business with the state in order to utilize business credit. You just need to have an employer identification number, even if that an EIN number is attached to a revocable trust. Buy a revocable trust, so that way you can make adjustments and corrections, update, add, subtract people, no people. This is why we're talking about credit.